On October 24th, 1929, the New York Stock Exchange collapsed. The ticker tape jammed. Brokers stared at the boards as panic swept the floor. In a single day, $14 billion in wealth vanished. The emotional impact was terror and disbelief, the pride of a decade's boom, the pain of sudden ruin, the shock of seeing fortunes erased in hours. But as the crowds outside Wall Street wept and raged, a handful of insiders moved quietly. In back rooms and at private offices, the rich, those with cash, credit, and connections, began to buy. Blue chip stocks, prime real estate, entire companies changed hands at fire sale prices. The emotional echo was envy and suspicion, the pride of survival, the pain of watching opportunities slip away, the shock of learning that disaster for many was a windfall for a few. A single day erased millions of dreams and minted new millionaires. How do the rich turn disaster into opportunity? The answer is in the way every crash from 1929 to 2008 to 2020 follows the same hidden playbook: panic, liquidation, and quiet accumulation by those who know how the game is played. The panic of 1929 feels disturbingly similar to the uncertainty of every modern crash. The headlines change, but the pattern remains. In every era, the world's leaders promise stability. Each time the rules change and the dominoes fall faster. But to see how the game is played, we need to go back to the rules the rich wrote for themselves. In every crash, the rules are the same, but only a few know how to play them. In the 1800s, as banks failed and markets seized, the richest families in New York and London kept cash in vaults and gold in safes. When panic hit, they bought up railroads, factories, and farmland for pennies on the dollar. The emotional impact was envy and anger, the pride of survival, the pain of watching neighbors lose everything, the shock of seeing fortunes made in the ashes of disaster. The secret was liquidity. While the masses scrambled to sell, the wealthy waited with cash and credit lines ready. In 1907, as the Knickerbocker Trust collapsed, J.P. Morgan summoned bankers to his library and quietly bought up blue-chip stocks at rock-bottom prices. In 1929, as the market crashed, insiders with access to credit snapped up distressed assets, prime real estate, art, and entire companies, while the public was forced to sell. The emotional echo is timeless. The panic of 1929, the crash of 1987, the meltdown of 2008, each time, the rich turned disaster into opportunity. The term countercyclical investing became a whispered strategy: buy when others are forced to sell, hold when others panic, and wait for the recovery to multiply your wealth. But the playbook isn't just about money, it's about access. The wealthy have private bankers, family offices, and networks that share information before it hits the headlines. They know which assets are truly distressed and which are just temporarily unloved. The emotional toll is frustration, the pride of being prepared, the pain of being left out, the shock of learning that the game is rigged for those who can wait. Why do the rich always have cash when everyone else is broke? What happens when a crash becomes a shopping spree for the elite? The answer is in the way liquidity, patience, and privilege can turn every crisis into a new beginning for those at the top. The secret isn't just money, it's access, networks, and timing. In the world of high finance, information is power, and the richest have always had more of it. In the 1920s, the most valuable asset on Wall Street wasn't a stock or a bond, but a seat at the right table. Private clubs in Manhattan and London, from the Knickerbocker to White's, became the nerve centers of the financial elite. The emotional impact was exclusivity and suspicion, the pride of belonging, the pain of exclusion, the shock of learning that the fate of markets could be decided over a single dinner. Family offices, private investment firms for the ultra-wealthy became the ultimate insiders. They hired former regulators, ex-bankers, and political fixers. They paid for research no one else could see. The emotional echo was confidence and secrecy, the pride of being first, the pain of being copied, the shock of seeing a rumor become a market move. The economic term information asymmetry became a daily reality. The rich didn't just have more money, they had better data. They knew which banks were in trouble before the public did. They saw which companies were about to be rescued, merged, or broken up. The emotional toll was frustration, the pride of being in the know, the pain of being left behind, the shock of seeing the market move before the news broke. Market signaling, the subtle cues that insiders used to communicate, became an art form. A sudden spike in bond buying, a quiet shift in credit spreads, a well-timed press leak. The rich watched for these signals, coordinated their moves, and acted before the crowd. The emotional impact was anticipation, the pride of being a first mover, the pain of being too late, the shock of seeing opportunity vanish in a flash. The first mover advantage is the ultimate prize. In every crash, the insiders buy first, sell first, and recover first. The emotional echo is envy, the pride of a winning bet, the pain of missing out, the shock of realizing that the game is always tilted toward those with the best connections. How do the rich know when to buy before the headlines hit? Why does every crisis reveal a hidden club at the top? The answer is in the way networks, information, and timing can turn a panic into a windfall for those who move first. But even the best networks need a system that protects their advantage. When the crash comes, the system doesn't just break, it bends to protect those who know how to play it. In 2008, as Lehman Brothers collapsed and panic swept the globe, the world's central banks and governments moved with unprecedented speed. The emotional impact was relief and outrage. The pride of a system saved the pain of seeing the rescue go to the top, the shock of learning that the rules always seem to change for those with the most to lose. Bailouts became the word of the decade. The U.S. Treasury and Federal Reserve injected trillions into the banking system. Troubled Asset Relief Program, TARP, funds flowed to Wall Street's biggest names. The emotional echo was fury, the pride of survival, the pain of watching Main Street suffer, the shock of seeing bonuses paid out as foreclosures soared. But the system's safety net was woven long before the crisis. Regulatory capture, the quiet influence of bankers and lobbyists on lawmakers, meant that the rules were written by those who stood to benefit. Tax codes favored capital gains over wages. Bankruptcy laws protected assets in trusts and offshore accounts. The emotional toll was cynicism, the pride of clever planning, the pain of public anger, the shock of seeing the same faces in government and finance. Central banks unleashed quantitative easing, buying bonds, lowering rates, and flooding markets with liquidity. Asset prices rebounded. The rich, who had bought at the bottom, saw their wealth soar. The emotional impact was envy and resignation, the pride of a winning bet, the pain of being left behind, the shock of seeing inequality widen with every new rescue. Moral hazard became a household phrase. When the system guarantees that the biggest players will be saved, risk-taking grows unchecked. The emotional echo is fear, the pride of a system that never fails. The pain of knowing that the cost is paid by everyone else, the shock of realizing that the next crisis is already being seeded by today's solution. How did the 2008 rescue make the rich richer? Why do the rules always seem to change for those at the top? The answer is in the way policy, power, and privilege can turn a crash into a new beginning for the few, and a long recovery for the many. The real secret isn't just surviving the crash, it's owning the recovery. As the dust settled after each crash, a familiar pattern emerged. The markets, once frozen in panic, began to thaw. Stocks rebounded. Real estate prices climbed. Art, collectibles, and even rare wines soared in value. The emotional impact was envy and resignation. The pride of a few who bought at the bottom, the pain of millions left behind, the shock of seeing the gap between rich and poor widen with every new boom. This is the age of asset inflation. Central banks, flush with the memory of crisis, kept interest rates low and liquidity high. The rich, who had bought distressed assets during the panic, watched their portfolios multiply. The emotional echo was frustration, the pride of a winning bet, the pain of being priced out, the shock of seeing the same cycle repeat. The wealth gap became a chasm. In the 1920s, the roaring 20s made millionaires out of a lucky few. In the 1980s, leveraged buyouts and Wall Street deals minted a new class of billionaires. After 2008, the recovery was even more lopsided. The top 1% saw their share of wealth hit new records. The emotional toll was anger, the pride of success, the pain of inequality, the shock of seeing the American dream slip further away from most. Capital gains, profits from rising asset prices, became the engine of new fortunes. Tax codes favored those who owned, not those who worked. The emotional impact was disillusionment, the pride of building wealth, the pain of seeing it taxed less than a paycheck, the shock of realizing that the rules were written for those who already had the most. How does every crisis widen the gap between rich and poor? What happens when the recovery becomes a new boom for the few? The answer is in the way the system rewards those with cash, courage, and connections, and leaves the rest to pick up the pieces. But the pattern isn't just about money. It's about power, politics, and the rules of the game. Every crash is a test, and the results are always the same. The rich and the rest live through the same headlines, but in different worlds. When the market turns, the wealthy have access to credit, even as banks tighten lending for everyone else. Their phone calls are answered. Their deals are quietly approved. The emotional impact is frustration and resignation, the pride of privilege, the pain of exclusion, the shock of seeing opportunity reserved for the few. The credit cycle is the engine of this advantage. In good times, money is cheap and plentiful. In bad times, it dries up, except for those with the best collateral, the deepest networks, and the longest track records. The emotional echo is envy, the pride of being too big to fail, the pain of being too small to matter, the shock of learning that the rules change depending on your balance sheet. Financial repression, the quiet manipulation of interest rates, inflation, and regulation, often hits the middle class hardest. Savers see their returns vanish. Wages stagnate while asset prices soar. The emotional toll is disillusionment, The pride of hard work, the pain of seeing it outpaced by speculation, the shock of realizing that the system rewards ownership over effort. Social mobility, the promise that anyone can rise, becomes a myth in the aftermath of a crash. The rich, having bought low, ride the next boom to new heights. The rest struggle to recover, burdened by debt, lost jobs, and missed chances. The emotional impact is bitterness, the pride of resilience, the pain of lost dreams, the shock of seeing the ladder pulled up just as you reach for the next rung. Are today's crashes just new versions of the same old game? What did past crises teach about the dangers of letting the gap grow? The answer is in the way every boom and bust reinforces the perpetual advantage of those who start at the top. So what can you do as the next crash approaches? Every crash is a mirror and a warning. The rich get richer, not by luck, but by design. The system is built to reward those with cash, connections, and the courage to buy when others are forced to sell. The emotional echo is timeless. The pride of a winning bet, the pain of a missed chance, the shock of seeing the same playbook run again and again. The lesson is clear. In every crisis, the rules bend for those who know how to use them. Liquidity, information, and access are the real assets. The dominoes always fall faster than anyone expects. The rules always change when it's too late for most to prepare. Will you be ready when the next crash becomes someone else's opportunity? Will you recognize the signals before the headlines hit? The answers are hidden in the past, if you know where to look. Don't assume the rules of money and power are set in stone. Watch for the signals: rising leverage, sudden deals, the quiet buildup of risk. Pay attention to the canaries, liquidity crunches, new forms of speculation, and the fine print in every contract. In every reset, someone is early, someone is late, and someone never even realizes a reset happened. Will you be ready when the next play is made? Will you recognize the signals before the headlines hit? Subscribe for more cinematic economic history and learn how to spot the next play before it happens.